I wanted to recognize our sponsor today. Eversource has generously stepped up to the plate and sponsored this event, so please join me in thanking Eversource for their generous contribution. I think we'll get right into today's program. We are very, very fortunate to bring back a keynote that has come here before and provided some great economic information for us. Jeff Fuhrer is Executive Vice President and Senior Policy Advisor at the Federal Reserve Bank of Boston. Jeff's been an associate economist of the Federal Open Market Committee and regularly attends this key U.S. policymaking meeting with the bank's president. In June of '92, he joined the bank's research department as an assistant vice president and economist, and from 1995 to 2001, headed its Open Economy Macro International section. In 2000, he was named Senior Vice President and Monetary Policy Advisor, and in 2001 became Director of Research, and in 2006 was named Executive Vice President. Jeff began his career at the Board of Governors of the Federal Reserve System, first as a research assistant, and then returned as a senior economist after earning his doctorate. He's been active in economic research for more than 3 decades and has served as an associate editor for the American Economic Review and has published many other pieces as well. He earned his A.B. in economics with honors from Princeton University and received his M.A. and Ph.D. in economics from Harvard University. So please join me in welcoming Jeff Fuhrer.
I was just saying as we were sitting at the lunch table, who needs to know all that stuff? I mean, what difference does it make what my title was when I arrived at the Fed in 1992? More important is what kind of cookies you got in the center of the table there. Right? Those look good to me. So it's nice to be back, and it's nice to see familiar faces in the audience. I feel like I'm among friends. I hope that's true. And so I am going to talk a little bit today about what's going on in the economy, mostly around the country, a little bit in this region, but you probably know even more about that than I do. This is one thing I have to say, which is that the stuff I'm going to talk about today reflects my own views and not those of the chair of the Fed or the FOMC or anything else. Although it is true that in most respects the chair of the Fed agrees with what I say. I mean, she does. But anyway, that's the disclaimer. So we're going to talk about these things today. What's been happening, why we have been raising interest rates, whether we might do more of that, and a little bit about our balance sheet. We should talk about that at the table. It's big. And then just one other hot topic, which you might find amusing. We'll see. So recent history. So this chart shows you that the 2 most recent quarters of growth in the economy, GDP, gross domestic product, the value of goods and services produced by domestically located resources. So that was around 3% for both of those quarters. That's what the 2 black bars in the 2 right-hand clusters say. So 3% growth, that's pretty good. We were a little bit worried early in the year. If you look at the left-hand side of the chart, you can see that GDP growth was less than 1.5%. We thought, wow, that doesn't look great. There were things going on abroad. We were a little worried about whether growth was going to take off. A lot of that had to do with the red bar in the chart. So if you see there's a red bar dangling down there. And what that says is that inventory accumulation slowed down a bunch in that quarter. The rate at which people added to inventories slowed down a bunch. Those things tend to be pretty temporary in nature, and in this case they were, because you can see the red bars in the next 2 clusters for the second and the third quarter were actually slightly positive. So there was more normal inventory accumulation going on. So that's sort of short-run stuff. We tend to try to look through that. We do. And it turned out that partly because of consumer spending, which is the blue bars in there, consumer spending has been pretty good actually all the way through the recovery. And then more recently, the green bars, investment spending, capital spending, that's improved a little bit. That is looking to be a bit more durable than it was. There was actually, first 5-6 years of the recovery, there was this puzzle as to why investment spending was not recovering with the rest of the economy. Now it seems to be coming back online, which is great. The outlook is for essentially more of the same for the near term. So The second half of the year altogether probably will average 3% growth, so something, actually with revisions, it might be a little stronger than 3% in the third quarter, maybe a little bit less in the fourth quarter, but averaging 3%, that's pretty good. And an important implication of that is that when growth is as fast as 3% in today's economy, it's very likely that the unemployment rate will continue to decline, which is another way of saying we're growing a little bit faster than what is sustainable. The way we do that is we pull people out of the ranks of the unemployed to satisfy that additional demand. This chart shows you that that has happened systematically over the last 6 or 7 years. Those green bars, which are GDP growth on average over that time has been 2.1%. That's not incredibly fast, but it's been fast enough to produce significant declines in the unemployment rate. That's the blue bars all the way through. So for those of you who don't read graphs for a living, those blue bars are below the zero line. That means they're negative. That means unemployment is declining. So that's all that means. Growth above 2.1%, unemployment declining. I just told you there's going to be more of that. Growth in excess of 2% almost for sure. And so that portends future declines in the unemployment rate. So that's important to keep in mind. And we also think, although we'll talk more about this in a bit, that inflation is going to gradually move up from its current rate of a little below 1.5% to something closer to 2%, but there's some uncertainty about that. So here's a complicating factor. You won't be surprised to hear this. Fiscal policy. In particular, what's going to go on with the tax plan. So the bottom line is we don't know. We don't know. We do have to try to make a forecast for what's going to happen over the next year or two, but we don't actually know, even as of today, what's going to happen between the House and the Republican bills. Of course, we know the House bill passed, but we don't know what the reconciliation process will look like. And there are significant differences between the bills, and there are still things to be hammered out, and there are folks who are going to object to some things, and we're going to see how that goes. We just don't know. So one interesting thing here is whether a change in the tax on corporations will induce a lot of additional investment. Historically, the record on that is weak. I'm not saying it couldn't happen. I'm not saying I'm against tax cuts either. But I am saying, just looking at this chart, and there's deeper work than that goes behind that. The level of corporate profits is not highly correlated with the amount of investment spending. And in fact, corporations have been sitting on significant profits over the last 15 to 20 years. That has not led to dramatic increases in investment. They've also been sitting on a lot of cash, not just their profits, but the actual cash on their balance sheet. The stock of cash at corporations is quite high, and a puzzle has been why that has not translated so much into investment. It could be because of the tax structure. It could be because of a bunch of other things. But in any event, I don't want you to take away the message that nothing good will come from tax cuts. I also don't want you to take away the message that as soon as the tax cuts come, everything's going to be terrific. We may get some boost out of that, and in fact, our assumption is that we will. We will get some boost in economic activity if something like what has been discussed goes through. Our estimate at the moment is something like a 0.5 percentage point addition to GDP for next year and maybe for the year following. That's good. It is part of the reason we think unemployment is going to fall further, and we'll talk about risks with that come with that as well. So why do I think the outlook going for the rest of the year and into the next year is good? Well, look at some data. These are short-term indicators of growth. First, on the consumer side, auto sales have been pretty good of late. They took a real jump in the aftermath of the hurricane because you remember earlier when mortgages used to be underwater, now cars were literally underwater. And so when they're underwater, they need to be replaced. There was some spike there. There's probably some residual effect of that in the next month. So that's good, but also the overall consumer spending line, which is the other line on the chart, has been gradually trending up, as it has for some time, so that looks pretty good. As I suggested, capital spending, that's looking pretty good. This is a measure of shipments of capital goods to firms around the country, and that's real machinery that's getting to be installed and will shortly be part of the production process. That's looking pretty good too. That continues to trend up, so that's good. And then on the housing side, we had data just 2 days ago that showed that housing permits, these are single-family housing permits and construction, they're still doing okay. I don't think the trend there is going to be dramatic, but there's some ups and downs from month to month, but it seems as if housing is still doing okay, and it's partly because the fundamentals for that are pretty good. Interest rates are still at relatively low levels compared to history, and I'll show you more on that in a second. And income is growing, and net worth from other sources is doing pretty well. So not a dramatic expansion in housing, but a continued addition to GDP. Anybody know what share of GDP housing is? Does anybody know that off the top of your head? Sorry? 1/7, so like 14 point something percent. So that's one guess. Anybody have another guess? No. 10%. Yeah. So it's much less than that. Right. It's like 3.5% today. So small share of GDP. It is interest sensitive, so it matters. It's part of the way we affect the economy, and of course it matters because housing is important. But it's not so big. So even if, small fluctuations in the growth rate are not going to dramatically change the outlook for overall GDP. It's a big economy. Housing matters, but it's not huge. Just wanted to give you a little quiz. Here's the view from Concord, New Hampshire. I live close to Concord, Massachusetts. This is the important Concord for today, Concord, New Hampshire. And actually, this is the data for the Manchester greater metropolitan area because you can't get this high-frequency data on employment and unemployment for the Concord area. I'll get it for you next time, but this is what's more readily available. Anyway, it tells you what's going on right nearby. So the unemployment rate, as you probably know, is quite low. There are only 3 other states in the union, that's Colorado, North Dakota, and Hawaii, that have lower unemployment rates. That's partly a function of the demographic composition of the state for sure, but still, it's low. It's probably at full employment. And we were talking before I got up here about whether we hear stories about labor shortages. I think you're asking the question. And the answer is we certainly do. We hear from many of our contacts that labor is in short supply, not just in New Hampshire, but around many parts in the country. That's not true for every occupation or every sector, but it is generally true. And we'll look at some data to validate that in a second. So that's unemployment, and then employment growth. This is just the change from the 12 months prior to take care of seasonal issues. And that's been growing around 2,000 per year, net additions to this metropolitan area, which is not bad. That looks sort of the way it has. Lots of fluctuations for sure, but that looks sort of the way it has since the recovery started. So not too bad. This is not to say that everything's fine in New Hampshire or anywhere else. There are interesting long-run secular issues that you are well aware of. But at least in terms of these high-level macro indicators, the economy has recovered. We're probably at or even slightly past full employment. And generally, the economy is doing well. So why have we raised interest rates? Okay, so we were talking before at the lunch table about what is it, actually, Nana, you were the one who was asking, so you're responsible for what, inflation, you said, and employment? That's exactly right. That's our dual mandate. There it is on the slide. Congress gave this mandate to us. We're responsible for low and stable inflation, essentially, and also for maximum sustainable employment. And sustainable is very important because you can push an economy too far, and when you do that, it's not sustainable. So things that aren't sustainable don't last. I think that's a theorem. And so we try to figure out that magic Goldilocks level. Well, at least Tim got the joke. Magic Goldilocks level where we're at full employment but not pushing too far, but also not leaving people out of work who could profitably be employed. So let's think about the two parts of the dual mandate. First, the employment part. This chart shows you what's going on with average monthly employment growth. Did I say it? Oh, sorry. First chart shows you what's going on with some measures of labor market slack. So first, the traditional civilian unemployment rate, which is now at 4.1%. That's very low. I put a gray shaded area in there. That's something economists like to do on their charts. They put gray shaded areas in for a variety of reasons. This gray shaded area is showing you what the estimates of the long-run sustainable rate of unemployment are. So they're somewhere between 4.5% and 5%. We don't know exactly, but somewhere in there. But today, probably unemployment is actually below that level, meaning labor markets have probably been stretched a little bit beyond their sustainable rate. Not dramatically, and it's fairly recent, but that's something to think about, and I'll talk about that more in a second. The orange line that I drew next on there, on top of that, is a broader measure of labor market slack that includes, importantly, people who are working part-time for economic reasons, meaning they'd like to work more hours, but for economic reasons, they're working fewer hours. That number has also come down pretty much in parallel, as you can see, with the civilian unemployment rate. So also that looks good too. Right-hand chart shows you what I was starting to talk about, the monthly average change in employment over the last 3 months. And there are disruptions there in part that have to do with the hurricane, for sure, because some people who work hourly were not counted by their employers, so they didn't show up in the survey for a month. Fortunately, in Florida and in Houston, they're pretty much back to work now. In Puerto Rico, very different story, but they're not part of the survey, and so we worry about them, but they're not showing up in these national numbers. But anyway, so to show you there, so what's happened? Well, so there was a time during the recovery where we were creating on average 250,000 jobs a month almost. That was a few years ago. It slowed down to maybe 200. We're now at about 160,000 jobs per month. That is slower rate of net job creation. However, it's above the gray bar. So this is the other gray bar, which says, well, in the long run, given the demographic composition of the labor force, folks who are aging into the labor force, they've finished their education, they're come of age, or are entering the labor force for whatever reason, we'd like to see them get jobs. How many of those are there each month net? The answer is around 80 to 110,000, maybe 70,000 if you're pessimistic, but somewhere in that range, and that's what that gray bar represents, and clearly 160,000 a month is above that, which is why we continue to see declines in the unemployment rate, because we're not only giving jobs for folks who are newly entering the labor force, we're also employing some folks who were unemployed previously. But there's going to be a limit to that at some point. I just spoke a moment ago about shortages of workers. One indication that workers are becoming somewhat more in short supply is that some of our measures, actually now most of our measures of wage growth, are showing some increase in the rate of wage growth or acceleration in the level of wages. That's the second derivative. The first, there's no calculus in this class, is that right? Okay, so I won't say that. So wage growth is increasing. And there are two measures there. There's another measure that I am using, which is, these measures, one of them is trying to get at just the rate of wage increase for an individual occupation. The average hourly earnings measure and some other measures don't control for that, to just essentially say, well, what's happened to the wage bill overall in the average firm in the economy? And those are actually increasing a bit faster. The best measure of that is increasing a bit faster than that. And that does matter, because if what's happening is that firms have to hire folks who are average higher wage, one, that's an indication of labor market tightness. It also means that their wage bill rising might at some point pass through into inflation, because that's, for most every firm, that's the major cost for all of them. So let's keep going. So how does inflation today, so that's the second, so we talked about labor markets, right? That's the dual mandate. Labor markets, the second part is inflation. How does inflation compare to our goal? Everybody know what our inflation target is? Anybody know? Is that a victory sign, or did you say 2? Because we shouldn't declare victory just yet, because we're not at 2, but 2 is the number. So when we get to 2, we will declare victory. But yes, thank you for actually knowing. That's actually the typical proportion in a non-economist audience. About 1 or 2 out of 50 people know what the inflation goal is, which is interesting because we think that's important. So that is 2%. So how close are we? So here's a chart that shows that we were really close a few months ago. I show you 2 measures of inflation. One is the overall measure that includes most everything that consumers pay for. And then there's a so-called core measure, which excludes food and energy, because we don't really need food and energy to live, so why look at them? No, that's not why. Of course, we care about the overall basket, but it turns out that the core measure tends to, on average, tell us better what the underlying trend in inflation is, because food and energy are subject to all sorts of supply disruptions that are temporary and might make inflation go up and down temporarily, but in the long run, the core gives us a better sense of where we're going. So that's where we were in March, and then this happened. So inflation went down again. Is that what we expected? No, it's not. Were there reasons for it? Well, probably. We don't know what they all are, but some are here. There was a dramatic decline in cell phone prices because a bunch of cell phone providers were competing for subscriptions, and that made a difference. There was some stuff with prescription drugs. But honestly, it's getting to be a little bit late in the game for those still to be a factor. That happened in March and April. It is now November by my account, and so it's getting a little bit late for those temporary factors to be the explanation. Hurricanes will probably boost those numbers a bit. We'll see, but just recall, let's think about your own circumstances. How much do you care whether the national inflation rate is 1.6% instead of 2%? How many people care about that? Let's say on a scale of 1 to 5, how many would be above a 3? None. Okay. So it is not it's not a first order concern for the U.S. citizenry, but it is something we're responsible for. We say we're going to get to 2%. At some point we need to do that. So it's more something for us to worry about than you, I suppose. But also, look, inflation moves around for all kinds of reasons. We do not understand every jot and tittle of the inflation rate. So we believe it's going to go back up to 2%. If it started heading down further or stayed for another 5 years well below 2%, we would worry about that because we are responsible for delivering a 2% inflation rate. But for now, what I'm going to say is what I think is most likely is if the unemployment rate dips below 4%, it's currently at 4.1%, the odds that we're not overheating the economy in any way or shape are small. And when we overheat the economy enough and for long enough, one way or another, imbalances develop, things go wrong. And that's, my next chart is going to talk about that. So first, let me say, this was all about, remember, why are we raising interest rates? And because from the dual mandate perspective, from the perspective of employment and inflation, we are either at or maybe exceeding our goals. And exceeding goals on employment is risky. That's the chart I'll show you in a second. So what do people think is going to happen? The chart on the left shows you what's called a dot plot, just because it's got dots on it. And and what it is the assessments of each Federal Open Market Committee participant, so that's the monetary policy making body, that's their assessment of where they think the federal funds rate, the key policy interest rate, should go in each of the years indicated from 2017 through 2020, and then with a view about what it might settle down to in the long run when we're all dead. That's what John Maynard Keynes said the long run was. In the long run, we're all dead. So it was his way of saying the short run matters. Don't forget that. So, okay, he was a very droll guy. Anyway, so as you can see, the median, there's some dispersion of opinion there, to be sure, but the median shows a gradual increase in the federal funds rate over the next 3 years. So that's sort of the kind of thing they're thinking about. That's not a pre-commitment, but it is an assessment. The markets on the right-hand side are thinking something similar for the next couple of meetings. I'm focusing on December, coming in a few weeks, and the June meeting of next year. And that shows you the probability of the interest rate being at one of these buckets here. So the red bucket, which you can't see, is the odds that it will stay where it is today, which is between 1 and 1.25%. The reason you can't see it is because the market today assigns zero, I mean literally zero probability to that happening. I don't think it's a zero probability because if, say, like in the Superman movie, California split off the continent and it floated and sunk into the ocean, my guess is we would be lowering interest rates because things would be all right. So that's not a zero, literally zero, but it's a very low chance that we'll stay where we are. They're putting very high probability of increasing rates by 1/4 point in December, and a little bit of probability that it'll be more than 1/4 point. And as you look into June, that shifts to an additional 1/4 point perhaps in June. That's sort of the way markets think. Anyway, that's what we think more or less. That's what markets are thinking. We are not tying ourselves to that, but just to give you a sense, we're thinking of a gradual increase in interest rates. And to show you how gradual that would be, this is the increase that's projected in the blue line that came from that previous chart, essentially. And then what did we do the last 2 times we raised interest rates, back in 1994 and in 2004? And the answer is well, there's calculus again, because I'm going to talk about the slope of the lines, the dy dx thing. But have you remember calculus? Do you guys like calculus? I don't know, anybody? Yeah, right? I mean, some people do. Sorry, what? Sorry? Love calculus, right? I mean, calculus is like it's about the physical reality of the world. It is the slope of things and the rate of change and all that. It's really interesting. Anyway, so the slope of I can tell I'm selling this really well. The slope of these lines, obviously the rate of increase in the blue line is considerably less than that in the yellow and red line. So it's a much more gradual increase. It's also going to a lower place. It's only going up to maybe 2.75%. So both of those are true. Those are both different from the previous cycle. And just to show you, if I start the 2 lines from the same place, it emphasizes the difference in the slope. It's really a very shallow, very gradual increase in rates, in part because we believe the current normal rate of interest rates is lower than it was in preceding years. We can talk about that more after cookies. All right, so what are the risks? So I've told you from the dual mandate perspective why we would raise interest rates, and that we in markets believe we're likely to raise them some more. What are the risks to keeping rates so low? Or as some of my friends say, what is wrong with you guys? Why are you raising rates? We love low interest rates, right? And I'd say, well, because there are some risks to that. So one is they lead to economic instability. And I'll show you a picture on that in a second. And the others, they might lead to financial instability. There's a lot of talk about, look, interest rates have been so low for so long. People who are looking for investment opportunities say, I don't really like getting a 1% return on a 1-year Treasury bill. I would love to have a higher return, and I'm going to figure out a way to get that. How do you do that? Usually you take on more risk. And so that's an issue, is to the extent that there are institutional features of some important parts of the financial sector that lead them to take on more risk in the reach for higher yield, that risk at some point may materialize, or it will build vulnerability into the financial system should we have another economic downturn, which at some point may happen. So it's a thing to worry about. What I want to show you is a chart that you can take. How many are you going to a cocktail party tonight? Anybody? I am, actually. I'm going to a cocktail party tonight. Nobody? You guys are boring. Come on. You must be. It's Friday night, right? You can't all be staying home. Okay. Reviewing calculus. That's a good excuse for staying on. No, I wouldn't. Even I wouldn't do that. So when you're at your next cocktail party, these slides are all public domain. You should take this slide with you because you will amaze and delight your fellow cocktail partiers. And it says something really important, which you're going to understand once I explain what the chart is, which I have not yet. But anyway, so as I say, it almost speaks for itself. But so what's going on in this chart? I'm going to step over here for a second. Can you hear me in the back if I keep talking this way? That's good. All right. I'm trained as an opera singer as well, so I can project. Maybe we'll sing later. So look, this is another gray bar chart. The gray bars indicate. Anybody have a guess what a gray bar is in this chart? It goes back. Yeah, recessions, exactly. So it's a recession shading. So anytime you see a gray bar, there's a recession going on. Okay, that's one feature. Second feature is the red line is the difference between unemployment and the sustainable rate of unemployment. So I just told you on the previous chart that was maybe somewhere between 4.5% and 5% today. It's been different places over time. But what this says for it is what's the difference. So when unemployment is above the zero line, right, then it's really high, and not surprisingly, you're in or just after a gray bar. That's what a recession is. Unemployment gets really high. But what I want to focus on is the times when unemployment is below the sustainable rate. That's when it's in this negative zone here, like here, and there, and today. So every single time since World War II, which is before even I was born, when the unemployment rate spends any time noticeably below its sustainable rate, something bad happens, and it's usually a gray bar. That is, it's usually a recession. So that's an empirical regularity that is saying something, I think, intuitive, which is, look, when you stretch the economy beyond its sustainable rate, we don't know exactly where that is, but we have some idea. When you stretch it beyond its sustainable rate for too long, you build imbalances one way or another. In the most recent recession, the most important imbalances were in the financial markets and the housing markets and so on. Other times it's been something else. Sometimes it's been inflation, and then the Fed has stepped in to lower inflation from 5 or 6 or 12% to something more acceptable. So it's just that's the kind of regularity you don't see that often. So again, you take this to the cocktail party, explain it to people, and they'll go, holy mackerel, this person really knows economics and may even know calculus. So the point is, we would prefer not to get into those kinds of circumstances. We would prefer to have a stable and sustained recovery at full employment, not consistently pushing the economy further and further beyond its sustainable rate. That's kind of our job. That's what we like to see. So that's one of the reasons we're raising interest rates, to try to keep that balance struck. All right, just a couple more things. Someone was asking me at the lunch table about the Fed balance sheet. And as it says on the title side, it's big. It is big. Anybody know who in the U.S. has a larger balance sheet than the Federal Reserve? Any guesses? Sorry? The government? Well, they have a larger liability side for sure. That is true. That is true. So that's a good answer. Sorry, Warren Buffett does not, but he has a pretty healthy. Well, see, he's like, what is he worth? I forget, 60 billion or 80 billion or something. Amazon is worth, somewhere in that neighborhood, 100 billion, something like that. So that's pretty big. But no, we're not in the right league yet. How about financial institutions with a bigger balance sheet? Anybody? JP Morgan, Chase. Don't forget the Chase, because they bought them, and that's important to them. They don't let you forget that. JP Morgan Chase, or the other big ones, Goldman Sachs is big. They're smaller than Citigroup, though. Citigroup is big. Bank of America is a good size. None of them are as big as the Federal Reserve. Okay, so the units on the axis there are trillions of dollars, and the Fed currently has $2.5 trillion approximately of Treasury securities and $1.75 trillion of mortgage-backed securities. Don't worry, those are all, because those are all government guaranteed. They are. Right. So that's the only thing we're allowed to buy, and so it's good to laugh about that. But anyway, so we're at, this is only those two categories. We have a few other assets. The total is just at about $4.5 trillion today, and there's nobody, even around the world, the other central banks, there's one that's that's getting close. But we have the largest balance sheet, $4.5 trillion, which is more than I make in a week. So it's, well, that's true, isn't it? I mean, I bet it's more than everybody in this room makes in a week. Sorry? Oh, okay. Okay. So that's big. So how did we get there? Well, the way we got there was when the economy was doing really poorly back in 2008 and 9 and 10. We had reduced the federal funds rate, the short-term interest rate, as low as it could go. It's basically at zero. We'll talk about why that's sort of a constraint another time. But anyway, the economy still wasn't doing well, and so in order to influence the economy, what we did was buy a bunch of long-term assets so as to lower the yields on those assets. Right? So when we buy long-term assets like treasuries and mortgage-backed securities, we take them out of private circulation, but there's still people who want them because they're safe, government guaranteed. Stop laughing now. It's government guaranteed, and when they still want them, we took some out of circulation. They're in short supply. That bids the price up, but that's the same thing as lowering the yield on those returns, and that's what happened. It's difficult to identify in real time in the real world, but we believe we did, and so that's why we did it. We were trying to stimulate the economy by lowering long-term interest rates of various kinds when we couldn't lower the short-term rate anymore to influence them. Okay, so that's why they're there, but they're probably also still today exerting some downward pressure on long-term interest rates, and just as we'd like to normalize the short-term interest rate over time, we should probably normalize our effect on long-term interest rates through the balance sheet as well. So we want to reduce the pressure. We may also want to have some ability to purchase these assets again if the economy goes into a recession, because right now, Fed funds rate is at 1.25%. It's actually 1.125% on average. If we hit a recession today, we could move it down, but we wouldn't have that far to move it. And so we might be forced again to try to have to use the balance sheet to lower interest rates to stimulate the economy. So it might be good to have balance sheet capacity. Okay, so we'll see. There's actually a plan in place that just started being put into effect in October, whereby we are already reducing the size of our balance sheet a little bit each month. I didn't give you the chart on that because I thought you'd have more fun at your cocktail parties using the one with the gray bars and all that. But I do actually have a chart that shows what we plan. And what happens is, so unlike men, Treasury securities mature over time. And so, it's an old joke, but a good one. But so as the Treasury securities mature, what we have been doing is buying ones just like them to keep the size of our balance sheet the same. What we'll do is not buy them anymore and let them just roll off. And for that reason, the balance sheet will decrease in size. And then also, the mortgage-backed securities are actually made up of real mortgages. That's what they are. And as you probably know, mortgages prepay for all sorts of reasons. It's not that they mature very often, but more often folks move or refinance or whatever. And so those prepay. And when those prepay, we'll also not replace all of them. So our balance sheet is already declining in size, which should make you feel better. All right, so just two more quick things. And one is that although I told you we raised short-term interest rates, and I alluded to the idea that, you know, we normally affect the economy by not just changing the federal funds rate, a very specialized short-term rate, but also affecting rates on mortgages and business loans and auto loans and the exchange rate and maybe the value of housing and the dollar. So that's why we did that quantitative easing stuff, that balance sheet stuff, to try to affect some of those when we couldn't do it by moving the Fed funds rate. But as I said, we moved, starting in December of 2015, we have gradually moved the funds rate up about a percentage point. What has happened to those things that we think normally transmit our actions to the rest of the economy through rates they really care about because they were borrowing at them? And the answer is not what you would expect, right? So what's happened to stock prices? These charts are all indexed to December 2015 when we first started raising rates. So what happened to the stock market? It's gone up a bunch. What happened to the dollar? It's been up and down, but it's essentially at the same level it was back in December of 2015. What about interest rates? Okay, so the mortgage rate, which is the cyan-colored line. I didn't even know what cyan was until I started picking colors for my charts or whatever, but cyan, it's a blue. So the light medium blue line there, the mortgage rate is also essentially where it was back in December 2015. It was lower for a bit. We started raising it, went up a bit, but it's not very different. You can see it's not very different at all from where it was in December 2015. And also the 10-year Treasury yield, which is in I don't know, mustard. Trying to expand my color repertoire here, but anyway, it's very close to where it was. It was down as low as 1.4 something percent in 2016, but right now it's a little above 2%, which is where it was back in December of 2015, which is just to say, we're not the only thing that affects financial conditions, of course. We, the Fed, not the only people who influence financial conditions. We do rely on them for transmitting our intentions and our actions through to the rest of the economy. Right now, they're not really tightening in the way that we move the federal funds rate. That may be another good reason for normalizing our balance sheet, because as we said, that as we remove some of those assets, that's probably going to affect mortgage rates and the Treasury yield over time, which may also have effects on the exchange value of the dollar and so on. So we will see, but that's a challenge we're thinking about now. So just one other issue, and that is that there's legislation pending to some extent to change it's been written, it's been revised and so on, to change the way the Fed does its business. And the idea is that the Fed would follow a rule. And I want to show you that rule. So this is what happens. So that's actually the Federal Reserve building on 20th and Constitution Avenue in Northwest in Washington, D.C. This is true. So when my first job was after college was at the Fed in D.C. I walked up the first day to this set of doors right here to try to get in, and it was like the Wizard of Oz, like a guy pops out and says, "Go away!" No, there was nobody there, but I know there were people up on this floor, or this floor, who were looking down at me going, "What an idiot. He doesn't know anything." That was not the door to walk in. I did finally get inside, and I worked there for a few years, but that is the building. The proposal would say, forget about that. We don't need the folks in that building. What we need is this. Can you see immediately what that means? I assume. Okay, maybe not. So, but so what it says actually is, so FF is for federal funds rate. That's the interest rate we control. In any period, we'll set that equal to the number 2%, plus the sort of most recent inflation rate. That's what that is. Pi, for reasons that you don't need to worry about. We always call inflation pi. We just do. Anyway, so it's 2 plus the most recent inflation rate plus 0.5 times the difference between that inflation rate and our 2% goal, plus 0.5 times the difference between GDP and its equilibrium long-run full employment best ever level Y star. Okay. So is that crazy? No, it's not. It's not totally crazy. So this is supposed to be something like the equilibrium real rate of interest. For those of you who like that kind of stuff, you can say, of course it is. What this says is that in the long run, when this is at its target and this is at its target, the federal funds rate would be equal to sort of its normal rate, which is whatever you set the inflation target to be plus the long-term real rate of interest. Okay, so that's fine. Maybe that's 3 or 4% today, probably closer to 3. And then when it's not, when things are not quite right, you lean against the wind. If inflation's a little above target, you raise the Fed funds rate. If output is a little higher than sustainable, you raise the Fed funds rate. That also means if employment is a little below full employment, you lower the Fed funds rate. So does that make sense? Yes, as far as it goes, it does. But what it doesn't do is really tell us how we should set policy, say in the middle of a financial crisis, or when there are other things apart from inflation and output that are important for the Fed to pay attention to. Or maybe more importantly, when we set interest rates, it takes months for those interest rates to have an effect on the economy. And more than what's going on yesterday or right now is what's going on over the next year or two that really matters. So I've actually, believe it or not, this is what I do on Friday nights. I have written papers about this sort of thing to show that the Fed actually does behave systematically, which is a virtue of this. It's systematic, it's a rule, but not quite in this way. What they really do is they look forward, they try to forecast, they worry about the fact that this number is not fixed eternally at 2%. It's not like the speed of light in a vacuum. Remember the speed of light in a vacuum, 3 times 10 to the 8th meters per second? Does everybody remember? You don't remember that? 186,000 miles per second? Come on, guys, where's your science? This is a STEM economy we're in. You have got to get with it. How about Avogadro's number? Anybody remember Avogadro's number from high school biology? 6.023 times 10 to the 23rd. Actually, Nano. Yes, so actually, Nano actually knew this, so thank you. I don't know why I remember these numbers. I'm not a biologist today or anything. But anyway, take account of the fact that this is not an immutable constant. Neither is this. And so, anyway, they do behave systematically, but it's a little more complicated than that. Plus, there are some judgmental factors that come to bear. So, anyway, that's what I wanted you to know about the economy today and Fed policy, which is the economy is doing okay. We are correspondingly trying to normalize our stance of policy. There is some uncertainty about that for sure, but we think we're heading about the right direction, and we're proceeding gradually because we don't want to upset the apple cart. Okay?
Jeff, we enjoy having you here because you're not really the stereotypical economist, which I think we all appreciate. And although some of us may not be very good at math, rest assured we more than make up for it in soft skills. So thank you again, Eversource, for sponsoring today's event. Thank you all for being here, and have a great Thanksgiving holiday.